Welcome to Me Financial, the podcast designed to inspire your financial life. Hello, everyone, and welcome to the podcast. Thank you so much for listening today. I am Michelle Moses, your host. I'm a certified financial planner, realtor, and a former e-commerce store owner. And today we are going to be talking about stock options. And to talk about this, I have Jared Van Arsdale, CPA, here. Thank you for being on the show. Again, this is his second show.
Yeah, thank you for having me.
I find Jared very, very knowledgeable every single time I talk to him. And I know I said that in the other episode, but I'm very excited about this. Can I say very again? But Jared specializes in tax compliance, planning, and examination representation for individuals, estates, and trusts, and closely held entities. He provides business and tax consulting and is a partner at Ullman Co here in Phoenix, Arizona.
Yeah.
So thank you. And as I said, we're going to talk about stock options, and we're going to try to make this as simple as possible. This was a request from a listener because he has stock options at a privately held company. That means that it is not on the stock market. And so it's confusing to people as to how can they get stock options in a business that isn't traded publicly, you know?
And strategy, right?
Yes. Yeah. And so how can he utilize those basically? So let's just get started and dive right in about the different kinds of stock options. And we will be covering restricted stock units and restricted stock, all the restricted stock options too. You're going to see that they are very, very similar. And so the different kinds of options that you have are called incentive stock options, which we will call ISOs. And the other one is called a non-qualified stock option, or NSOs. Mm-hmm. Correct?
Correct, yeah. I think when you hear the term qualified, always think of pre-tax. When you have non-qualified, it's effectively just not that, right? And that's your effectively after-tax deliverable. That's
right.
The way you tend to think about them.
Just like a qualified plan is your 401k, right, and your non-qualified is after tax, which means you've already paid taxes on it. Yeah. Okay. Do you think that the more common ones are the incentive stock options? Those are the ones that I got when I was working.
Yeah, well, they're more common from smaller entities looking to grow.
Okay.
Right? Where if you're working for a public company that trades, the NSOs and restricted stocks are more common.
Really?
Yeah.
Okay, so if they're smaller, you're going to get incentive stock options.
Typically, yeah. You tend to see them a lot more in startup entities. Particularly, there's, the Palo Alto startup tech entities tend to use ISOs quite frequently, because the strike price or the exercise price is really, really low at the date of issuance, and because they're trying to deliver compensational value without actually having to come up with cash.
Right, because they can't issue the cash.
Right, the cash, exactly.
Yeah, and that's what, I guess that's what we should start off talking about is why do people, why do companies give these? And it's to basically give more compensation and to give bonuses to employees without actually having to
come up with cash
to do it. Right.
Yeah.
And so it's also a way where they'll get, a highly compensated person or, maybe a CEO or, a technology officer. And that is a way for them to then get them to recruit them,
incentivize them.
Yeah.
For not only for recruitment, but also incentivize them for performance.
Yeah.
Right. It's like your base comp is here, but the total value of your total comp is here if the company performs under your leadership or the combination of leadership, et cetera, right? And so tend to be like in startup entities, they don't have the cash to deliver the highly compensated employees' needs, right? It's like, hey, I know you're taking a 50% pay cut to come here, but I'm going to issue you all these options and ISOs and some other structured compensation. Right.
So you're going to participate in the growth of the company.
And to incentivize you to participate in that growth, to, obviously lend your hand to that growth. And at the end of the day, the goal is at year, 4, 5, 10, you have a large payoff, or, hopefully there's a version of a IPO or some type of private equity purchase or something where all of it
where you could
together.
Exercise those options.
Right.
Okay. All right. And so how would you describe, can we go back and again, so the ISOs, I think those are the simplest ones to understand, in my opinion, incentive stock options, because basically when you get these, right, you're getting like a sheet of paper or, whatever emailed to you. And so there's different things to be looking out for, right? And so what are those, because it's like the grant price, or there's different names for everything, right, and the strike price. There's a vesting schedule, just like you have inside your 401k, right? And what am I missing? Oh, and then there's any limitations on it.
Yeah, limitations and how's it measured, right? And things to that effect. But let's go through those definitions quickly, just to clarify.
I totally agree.
We have the grant, or with the date they deliver your option to you, right? So here's your grant date, right? Here, Michelle, your option to purchase 1,000, stock at some future point in time, right? Then you have an exercise date or a strike date, right? Where you actually take possession of the stock. You exercise your option, stock's delivered, right? And then after that, it's your asset at that point. The question is, where it gets complex is, where is the tax implication between date of delivery versus date of sale, and what happens in them?
Right. Because when you actually get the stock option, there is no taxable event.
In ISOs, yeah.
In ISOs, right. And it's just an option to buy the stock, because you could leave the company and then leave all those stock options behind.
Right.
Okay.
Yeah, there usually is there's significant limitations on the ability to transfer. Like if someone passes away or terminates employment, they're just gone.
Right, they are just gone.
Right, and more importantly, why ISOs tend to be with smaller entities or privately held entities is there's a $100,000 cap per employee. So you either just limitations on the actual ability to deliver a lot of value, right? So as a company increases in value, it tends to decrease the amount that you can deliver.
Okay. Okay. And so once you get these, it's not a taxable event. You just have the option to purchase the stock at a set price at a day in the future. So let's say you got 1,000, and then 2 years from now, you might be able to have 250, and then a year later, another 250 a year after that, so you're going out 4 years, and you have the option to purchase it at that same price. Right. Okay. So what someone can do is, let's say the vesting schedule is 2 years. You have the option to buy 250 shares at whatever that strike price is listed on there. And if you are at a publicly traded company, you're hoping that the stock price is higher than what is on your what you're granted.
You're not gonna exercise it.
Yeah,
right?
Otherwise you're not going to exercise it, because it would be better for you to go out in the stock market and purchase the stock for a cheaper price than for what you want, because you want them to be in the money. Isn't that what people? Yeah, that's what I used to say.
Yeah.
Okay.
And the item that you'd want to focus on with ISOs, these incentive options, is that they tend to be a very low exercise price, because it was delivered to you when the company was decreased in value, or early in stages, right? And so let's say it's $1. By the time that vesting schedule ends, hopefully it's worth $100, and you have 100x return, right? And you have this tremendous amount of spread between what it costs you versus the value you're receiving, and that is where the value is delivered to that employee, right, and to the people that we represent, right? But what they do with it, and what the intent of that is for them is simply are they trying to exercise and take it home as compensation, like exercise and sell type of thing, where you have obviously a taxable event at the date of sale. So take a step back. The ISOs are generally determined to be qualified or pre-tax until the date of sale, right?
So once you exercise and buy the actual stock, that's when you owe some tax. So let's pretend you're going to hold on to the stock. Okay. You're not going to buy the stock and then immediately sell it in the market. You're going to exercise your 250 options to buy 250 shares, I should say, and you're going to hold on to the stock. That is a taxable event, correct?
On ISOs, when you purchase it, the reason it's qualified is you purchase it at the decreased value, take possession. We don't have an immediate income tax impact.
Okay.
But often the reason we tend to see tax paid is because, mainly we don't exercise unless we plan on selling, right?
Right.
That's the most common, right? We don't tend to exercise and pay the money and just take possession, because often there's not a market to sell it to, right?
Okay.
So we tend to exercise and sell instantaneously because the market opens up for us to sell.
Right. Okay.
Does that make sense?
Yeah.
Okay.
So most people with incentive stock options will exercise and sell within one day.
Usually.
And then it'll become a taxable event.
Yeah.
Okay. And we should really plan on that you're going to take home like 70% of that.
Yeah. Yeah. And yeah, for the most part, right? So here, I don't want to get too into
Yeah,
the weeds of the tax.
yeah.
because
I'm just saying an estimate.
Yeah, exactly. There's depending what you want to focus on is the spread between the market value and your exercise price, what you're paying for it, because depending on what happens, that's where the tax impact is, right? And if you sell it instantaneously, absolutely, you have immediate tax impact, right? If you exercise and hold, there still could be a tax effect associated with AMT, really complicated, and it gets even more complicated the longer you hold them.
And this is why Jared has a job.
Yeah, a little bit. And it gets, but sometimes that happens simply because an employee wants to take possession before a subsequent event, right? There's a company coming in to buy it, or
they're going public.
Or they're going public, or something's happening where they need to take possession and they don't have a means of sale to the market. Right?
Okay.
And so they end up having this possible tax event from AMT purposes. But if there's an open market for you to sell into, yes, absolutely. More often than not, you exercise and immediately sell, be okay with paying the capital gains. And yeah, you might end up walking home with 70, 75 cents on it.
Okay. And so for my listener question of privately held company that is issuing stock options, there is no option to exercise them until there is someone coming in to purchase the company, or that company is going to be going public.
Yeah.
Correct? Okay.
Yeah, that's pretty common because they need a source of cash to pay you, right? The reason you're getting these is because they can't give you compensation via cash. So an external party coming in.
They're just trying to incentivize you to grow the company so that they can then go public, because that is like their goal.
Right.
Okay. And I think it's a good time to mention this, that there are investments in my world where they will go into companies. And this happened with, I think Dropbox is a good one, that they went into Dropbox before it went public, and they give the employees an option to purchase all of those stock options. And then what they do is they pull them together and they make funds out of them. And so a lot of employees will like to do that, just so that they aren't at the whim of the market and it's kind of a sure thing. So that is an option, but you definitely, if you are at a privately held company and you have these stock options, just know that is an option before you actually go public. And it's usually 6 to 12 months before all of that.
Yeah, usually
happens.
Yeah, it's usually like a little blackout window where they allow external parties to come in and buy, right? And the thought process is that you can create some certainty for yourself.
Exactly.
Right? It's like, I have a lot of risk on the table. Let's say it's 90% of my overall compensation for X number of years. This is one particular set of options. And the price after IPO could fall through the floor.
Yeah, you don't know what it's going to do. Yeah.
So this gives me some certainty. I could sell it to some party and take some money off the table before the whims of the actual tradable market take it for a ride.
Right.
It's kind of the thought process.
Right.
And these companies come in and they might try to buy, they're going to try to hedge their risk associated with buying it at a discount from you. But again, it's a certainty versus uncertainty. How much do you want to leave to the whims of the market?
Yeah. I think it's kind of like I did an episode on annuities. You're giving up a little bit of money for some certainty.
Yeah.
Yeah. And that's just what people do. Yeah. Okay. So have we missed anything just on the covering the top level of ISOs? I know it can get really complicated based upon whatever your personal tax situation is and whether you should exercise them. Yeah. But I think just as general knowledge.
Yeah. The one thing to note, simply from determination of tax, is that there's one item called what's called a disqualifying disposition, meaning that you exercise an ISO, you have another hold period afterwards within usually 1 or 2 years. And if you sell within that 1 or 2 years after exercise, you have ordinary income.
And what are these called?
It's called disqualifying disposition.
Okay.
Right. And so, because the whole point of it is to incentivize you to hold, right? Mm-hmm. That's why it's pre-tax compensation. Well, if you sell it too quickly after you take possession, you have a disqualifying disposition. Sometimes it doesn't matter because the prices tend to align. But sometimes it does when there's an increased value. So
when there's a huge difference in price,
that spread is big.
So let's say your exercise price is $10, and the size and then the price of the stock is $100. So you're saying that is too big of a.
Well, it's It's a differentiation in the tax rates, right? Whereas if you have a disqualifying disposition, it could result in ordinary income where you're planning on capital gains, which might be 10 or 20% less.
And how do you determine if it is this disqualified
There's a whole
disposition?
period after you take possession. It's
all the time?
I wrote it down. 2 years from the grant date or 1 year from the date you exercise.
Okay.
So
and this is always with ISOs?
Always with ISOs.
Oh, okay.
Yeah. So, and again, if the spread's not too big, it doesn't matter to you too much, right? But if the spread grows by the time you get to there, sometimes it might be valuable to exercise and hold, right? To kind of lock in the price and get past that date. So when you do sell, it's all capital at that point in time.
Well, and especially if you're thinking about leaving, you're going to want to exercise, hold the stock, and then hold it for.
Right.
Is it what? Can you repeat the?
Yeah, 2
time
years
frame?
from the date of grant, or 1
Okay.
year. 1 year from the date you exercise.
Okay, so if you get granted, I think that's a lot of times why they have the vesting schedule and the limitations. Is just so that you have to, once you're issued the stock options, because I've never heard that, but I've always just seen it that you can't sell them for 2 years. Like, so once they're issued, then you can't exercise them for 2 years anyway.
Yeah.
And then you've got your vesting schedule
The one
after
that tends
that.
to bite us isn't the 2 years from grant. We tend to be locked into that. The one that tends to bite us is the 1 year from the day you exercise.
Okay.
Right. And it's because sometimes you exercise and immediately sell. Sometimes if that price is too far apart, you might have an ordinary income impact associated with that. But it really depends on all the facts. I just make note of it. Just assume that just because it's an ISO doesn't mean it's always capital.
Okay.
Right. So there could be a portion that comes out as ordinary income.
So basically you get granted, you wait 2 years, you buy the stock, you still have to wait another year?
Right.
No matter what.
No, you can do whatever you
You can
want.
do, I mean, you can exercise it, but then it becomes ordinary income.
Yeah.
But if you wait a year and hold that stock, then it becomes capital gains.
The computation's a little bit more complicated than that,
Yeah.
but give it to that thought
Okay.
process. But can I make just one general thought process? here?
Yeah.
Is when you think of any version of option, if your goal as an employee is to treat it as compensation, be okay with some of it coming out as ordinary income because you don't plan on holding it, you plan on taking it home, right?
Okay.
If your intent is to stay on the wave of growth with that company and hold it as an investment, then be okay with holding it as an investment.
Okay.
Right? And then you get the benefit from the lower capital gains rates, but you also take the risk associated with holding that position longer.
See, I love that. And that's what I love about finance is that we can get into all the numbers and taxes, I mean, all of it. But it's really a mindset. I mean, and so you have just wrapped that up in this little succinct, statement. And I just love that because it's just a change of mindset.
Yeah, exactly. Because if I had a number of clients, particularly I think of like GoDaddy, Cloudera, Slack, Red Hat, all these other ones where you have these large accumulations of stock options, right? And one that really comes to mind is a client that had like 25 years with accumulated options and ESPs and everything, all at IBM. Thankfully, IBM's price has stayed steady for 25 years. Mm-hmm. So they're not really too much impacted by that. But the companies have a lot of valuation changes. A lot of them, if you hold a lot of it, a lot of your whole
your whole
net
wealth,
worth
is in this one stock.
Regardless of what the tax cost is, take some of it off the table every once in a while.
Yeah,
right. And
because you don't want to have all your eggs in one basket.
That risk is really, really high, and the tax cost. As I think of it as you exercise, and let's say the price is 100, and you have this huge tax impact, and you're just really I can't justify paying 37% tax rates on this delivered.
Yeah.
Right. And then 6 months later, the market takes 30% away from you.
You might as well just sold it and taken the money.
And taken the money. Right. You're in almost the exact same spot.
Right.
That you were 6 months prior.
Right.
And now you have to consider, do I take even less or do I got to sit here and take more risk and wait for it to come back?
Right.
Right. And
yeah,
so
I think it's important.
Minimize that bull.
Yeah, I just think it's really important that people don't focus so much on just not paying tax. Like you've got to pull yourself out of that and think about whatever your long-term goals are. You need to think about what could happen. And like a doomsday scenario.
Yeah.
Really. And is it really that bad to pay 30 or 35% and take home most of the money?
Yeah. So when you see the ISOs, they tend to be with, again, smaller companies or tech companies or some companies that need a lot of cash flow from the market to pay employees type of mindset. And there tends to be a lot of valuation change where you see these other options, like we go into NSOs, tend to be Fortune 500 companies or large publicly traded entities. And there's still a good amount of fluctuation in certain industries, but some industries are relatively stable. Think of like utilities and things of that effect, tend to be pretty straight across the board, right? You don't have too much value change in their asset position, and they're just getting more and more options, and it's really just compensation.
Yeah.
At that point.
Okay. And I think it's important to, you mentioned a couple of things an employee stock purchase plan. You kind of mentioned that a couple of sentences ago, or I guess a couple minutes ago. And these are different than the employee stock purchase plan. And those are where you're just buying the stock at a discount and you're just putting it into your account. It's pretty straightforward.
Yeah, it's after-tax money.
Yeah.
It's like instead of putting it in your checking account, you buy your employer's stock at a discount.
And just because you work there, you get a discount.
Yeah.
You know, it's like working at a retail store and you get a 15% discount for buying stuff there. Yeah. It's the exact same thing. And I have seen people get way too much stock in those, you know, like it's too much of their net worth.
It might feel like buying something on sale.
Yeah.
Right? It's like just because it's on sale doesn't necessarily mean you need to purchase it.
Yeah.
Every single time,
Or put that much of your net worth into it, you know? Yeah.
Right.
Yeah. So you just want to make sure you're not putting all your eggs in one basket. Right. And before we started, we were talking about how ISOs are very similar to restricted stock options. No. Units. Restricted stock units. Yeah. So if you have an ISO or restricted stock units, they're
NSO.
NSOs are stock units, but ISOs are the same as.
Yeah, so ISOs are pre-tax, right? That's their intent, and they have their income tax implications associated with it. We just spent a tremendous amount of time on. NSO, or non-qualified option, is pretty much an after-tax option because it comes out as wages. Restricted stock units are very similar. The contracts structured differently. That's why they have a different fancy title, but they also come out as wages. So when you see non-qualified options and their expiration dates and their vesting schedule, they tend to be granted to you, but you have limitations on access and vesting and take possession. Where a restricted stock unit is delivered to you in advance, is delivered to you in the future until you vest, right? So, but at the end of the day, in both those circumstances, the minute you take possession or you exercise, you have an ordinary wage implication. It's just added to your W-2.
So that means you're going to pay, and what he means by that is that you're going to pay Social Security tax, you're going to pay all your FICA taxes, your Medicare, all that kind of stuff.
What tends to happen is that the employer, and again, these tend to be Fortune 500 companies, they publicly traded companies, they sell approximately 1/3 of your options to the market to generate the cash to pay those taxes, right? So they'll pay you'll be granted 100, right? And 66 will appear in your Fidelity account. And you're like, I thought I had 100. Well, it's because they sold the other 33.5 to pay your Social Security, Medicare, and your income taxes.
Okay.
What tends to happen is, particularly when these numbers get really big, is that the income tax tends to be a little too low and you end up being underpaid at the end of the day. Not the worst place to be in because you just got a tremendous amount of value, right? But you tend to lose about 1/3 of the options before they turn into stock.
Okay.
In both of those circumstances.
Okay. So, and I think the point is that if you see the word restricted stock, whatever comes units or options or whatever comes after the end of that, that it is very, very similar to the stock options that we're talking about in this podcast.
Non-qualified options.
Yes. Yeah. So, okay. So there's basically the two. There's the ISOs and the NSOs. Sorry, we have so many, so many acronyms.
It's a good reason to know that even though you might spend a tremendous amount of time in this
Yeah.
area, it is incredibly easy to get tripped up.
Oh,
because
absolutely.
We name them all kinds of different
my
things.
gosh, yes.
We tend to call them different things.
Yeah.
Right. Employers will call them different things because they want to give it a fancy title for the fancy executive, and it all
ends up
gets
being the
mixed
same
up.
thing.
So we always have to try to break it down. And so ISO is pre-tax. Non-qualified is after tax. That's why it comes out as wages. Same as the reason I compare it to restricted stock units. This contract might be different, but for tax purposes,
it's exactly
it's compensation.
The same. Yeah,
it comes out, it adds to your W-2.
Whereas with incentive stock options, you could possibly make them capital gains.
That's the reason they're pre-tax is because you're trying to get the capital gains.
Yeah, and capital gains basically means that you're taxed between 5 and 15%, depending on how much money you make. So you're paying less tax essentially, whereas you're going to pay more like 30% of your wages if it comes as income as a wage, because you're going to be paying on all your Social Security.
Yeah,
FICA taxes.
When your income's high and you have like a marginal tax bracket in the 30s, it's going to feel like you're losing 45% of your value because of all the additional taxes and employment taxes on top.
Right. And that's why people freak out.
But again, it's compensation, right?
I know. And again, you're taking money home that you weren't going to be taking money, you weren't going to be getting it before.
That's why when you think of these after-tax programs like the restricted stock units and non-qualified options, tend to think of them simply as compensation being delivered in this, via stock.
Yeah.
That's just the way it's structured. Here's your units, go sell them in the market to get your money, the type of mindset.
And then you can hold it or you can sell it just like you would in any other stock account.
Yeah.
If you want to hold on to it and you believe in the company, that's fine. And it will be transferred into your own account. And then you can, I have some people that retired and we exercised a lot of these and then they held on to the stock because they thought it was going to go up. And then we sell them for their vacations every single year.
Yeah.
And that's just how we look at it.
Yeah. It's just, at that point, you've been delivered the value. You can choose to diversify it however you want.
Yeah.
At that point.
And I think it's important, how I couldn't remember the acronym. These things, they are very complicated, you guys. I mean, this is why you have people like Jared to go to and ask whether that you should exercise them. I remember when I first took this job, I really beat myself up that I couldn't remember the contribution limits for IRAs and all of the retirement plans, that I really committed to that every single year. And then one time I saw a CPA be like, I don't know, I can't remember, and then looked it up and I was like, oh my God, I can just look it up. I don't need to memorize all of this. I just need to know where to look it up. And so
it changes every year.
Yeah. Everything changes. You can't fit it all in your head. And I even got notes in front of me and I was like, oh, is it an NSO? Is it because there's U and S and there's all kinds of acronyms. So don't beat yourself up because we can't remember it either. We know what we're talking about, but to be able to specifically say, what it is, that takes a whole nother level.
Yeah. I think that ultimately I got one more we want to quickly touch on in regards to restricted stock itself. But I think the number one takeaway I try to convince all of our clients and people I talk to is simply determine your goal of what you're going to do. Right. And that might change the longer you're there, 6 months in, you're like, I can't do this anymore.
Mm-hmm.
It might change.
Then you're like, I better exercise these because I need to get out of here.
Yeah, exactly. And your incentives change, life happens, whatever it might be, but try to identify a plan and then quantify its value pretty consistently. Like every quarter, every 6 months, kind of revalue and see how much of your net worth you have in this one thing, and then adjust your plan. As it's like, what, I need to take some of this off the table, and here comes an option for me to do that, or something to that, and then go from there. Because the last thing you want this large accumulation of your net worth in there, and then because of inaction, you allow it just to go an extra 6 months or so, or another year, and the valuation falls off the table, and now you're stuck.
Yeah.
Right. And that's probably the worst circumstance. And it's happened a lot, with these entities, particularly startup entities where they have huge valuations. And humanistically, we want to just say, yep, it's just going to keep going. Right. And then the value drops by like 80-90% because a competitor enters the market or something like that. And then you watch like 90% of your net worth disappear.
Right.
Right.
And so it's more about taking a balanced approach and And I've seen that happen. And stuff can happen just out of the blue. It's there's a lot of people here in town that work for Wells Fargo, and when they had that big where they were opening up all the accounts and they have all the penalties, and their stock was flying high for a long time, and a lot of people weren't worried about it. Oh, they're doing great. Well, they're not. Not everybody does great forever.
Yeah.
It's just kind of the name of the game. So do you think we're missing anything? I feel like we kind of touched on.
Yeah, well, let me touch on one thing,
Okay.
because this tends to come up a lot with, again, it's not similar to ISOs, but it tends to enter the same conversation. That's just restricted stock or restricted stock awards. You tend to see, usually the valuation is issued in these privately companies, small companies, at zero. It's like you're getting this stock option because you're entering in when everybody else, we just started this company. I'm going to give you some options. You can't do anything with them. They're valued at zero, but here's what's called an 83B election filed with the IRS. And it tends to confuse somebody pretty quickly because they have no idea. They just know they're starting a new job, right? And they got these options that are currently worth nothing, But that piece of paper is incredibly important because it locks in the price for tax purposes at the price at the date of delivery.
Okay.
So restricted stock is not the same thing as restricted stock units or RSUs. Restricted stock is simply stock that you're being delivered today, and that's taxable to you at its value at that point in time. We tend not to see that very often unless the price is zero or something really, really small, right? And I think.
And so if they don't file that, will the IRS not believe you?
No, if you don't file it, you're effectively tax implication is at the later point in time
of whatever the stock price is.
When the exercise price is significantly higher. So we
Okay.
tend to make this election. You can elect to pay tax at the date of delivery. Absent that election, you pay tax at the date of exercise. And that might be a very significantly higher market value.
Oh, wow.
Right? So let's say, for example, we start a company and you issue me units and you say, it's currently worth nothing because I literally started it 5 minutes ago, but here's an 83B election because you got 25% of the company. Make sure you file it because it has a zero valuation or zero transfer market value, right? After that point in time.
So essentially you wouldn't pay any taxes because it's zero.
I recognize the taxable event, but it's zero in value. But everything after that is capital gains, right?
Mm-hmm. And remember, that's the lower taxable amount.
Yeah, and the benefit is I've made this election, I've locked in these lower tax rates, right? Absent that election, which tends to happen because they tend to not file it, they get it and they forget to file it with the service.
What if they found it 2 years later in their paperwork? Could they file it then?
It gets into a...
Maybe.
No, the answer is no, because
Okay.
the line, you have to have a timely filed at the date of transfer. So if you let too much time go by, you can't go back and retroactively define your intent.
Okay.
So the election's gone. It has to be timely filed.
Okay.
And so the thought process being is that a good example. I had a client that I think it was a medical consulting or surgical center type of thing, and the company had just started. They had valued his options, restricted stock options, at I think $1 or maybe like $1.40. They actually had to hire someone to come up with this complex value. And I think he had like a $40,000 income event as a result because he had 100,000 options or something. He paid tax on that $40,000, that valuation, but he got no comp. He got no cash for that. 6 years goes by, and the valuation is now $2.40, right? He pays tax on that appreciation at capital gain. Absent that election, 83B election, he would have paid ordinary income at the 240 instead of...
For all of the 240.
For all of it.
240 times however many shares.
Yeah, exactly. So it's again, I've only seen it common in small entities that are starting because they want to deliver this immediate tax value when the valuation is significantly smaller.
Okay.
And sometimes it turns into nothing. It's zero today, and 5 years from now, it's still zero.
And that's just straight restricted stock.
It's straight restricted stock.
Yeah, not a restricted stock unit or,
Yeah, the same thing process is the one item that is comparable to ISOs is that it tends to be, you can't do anything with it until 10 years' time when we sell the company. Or IPO or some buyer comes in, some liquidity event happens, and they can pay you.
Right. And I think it's important to say this, that when a company issues these, there's usually somebody at the company or a lawyer that they've hired or someone that if you were to ask around at HR, the person that does your benefits, that they'll be able to direct you to someone that would be able to explain this or at least send you an email to explain it. And then you could send it to somebody like us. So I know that there's options out there. So don't just get these things and just go, well, I don't know what it is. You know, there are people at your company that will probably be able to explain it. And they probably do have some sort of marketing piece put together that will explain what you have.
Yeah. Don't ask HR. HR will be glassy-eyed. I have no idea what you're.
Well, I know, but they know where to point you. You know what I mean? They know like the ways, who put this all together and who put the plan together.
Absolutely. Yeah. Because the whole purpose of the employer is to deliver value to you.
Yeah.
That they can't currently give it to you in cash, right? So they want to say, listen, I need to keep you as talent and I need to keep our team. I need you to know that I'm giving you a tremendous amount of value. So here's, Sally and Jeff, and they'll tell you exactly how you quantify this and how you get your value out of it at some future point in time.
Yeah. And I think when you're thinking about these, and they are so complicated, obviously, I mean, because we're just touching the surface of them, that it, just come away with one little thing. And I think Jared's point about just knowing what your intent is if you're going to just use it as compensation, or if you really believe in the company and you're going to stay there long term, that's great. That you could just remember that one thing and know that gives you a purpose with with this one part of your bucket. I'm going to put it that way. And so I don't think you need to remember all the details because, gosh, we don't remember all the details of everything. We have to review files. And
I may have only spent like an hour and a half remembering.
I know. I may have spent like an hour and a half studying yesterday to make sure that I remembered how these work. And so don't beat yourself up. I mean, this is, we have to go back and, somebody comes to us and then I say, well, let me look this up and make sure I know, because it's not as common as, hey, I'm just going to put money in an IRA. That I can just do off the top of my head. But a lot of this stuff, and especially it reminds me of cash balance plans, a lot of that stuff just gets very confusing. So if you have all of these, DB plans and, stock options, just know that they do take just some research.
So here's a great point I try to press with a lot of clients. Every time, and I think we talked about this when I was on last, is that in exchange for a tax benefit, a lower rate or a deduction or something pre-tax, you're always giving up something in exchange, right? Talk about cash balance plans and other things to that effect. And they tend to come with complexity, right? So you want to make sure that the dollars assigned to this complexity are worth it, right? Before you dive head into it, right? And so we want to, often these options tend to come up with a tremendous amount of future value that you can't easily quantifiable today, right? And there might be some complexity at the front end to understanding that, but just know that when the valuation does go up at some future point in time, it was worth the effort.
Right.
Right. When you're purposely adding complexity to your life and you get $1,000 of value, be okay knowing that you just wasted your time and your effort.
Yeah.
And some money maybe, type of mindset. Just make sure that if you're adding complexity to your life, that you're getting something in exchange.
Yeah. I kind of use that when people want to buy a house with an IRA.
Yeah.
I'm like, it's very complex. There's a lot of paperwork, and we need to make sure that you want to do something like this.
Yeah. So we're going to add a couple third parties involved.
Yeah. And you're going to have a lot of fees, and you're going to have to do a lot of paperwork, and it's going to be a lot to keep up with. Is it worth it? And I think that's, those are the kinds of things to think about, because it just gets more and more complicated because there's, I just think of it more legal jargon and more legal paperwork and things like that. So, well, Jared, thank you so much for being on. And everybody, I hope that this shed a little bit of light on stock options and just gave you walking away with a couple things that you've learned. And thank you so much for listening. And be sure to leave a review or let me know if you have other topics that you want to hear about. Thank you so much, guys.